The Fibonacci retracement is a popular technical analysis tool used by traders to identify potential levels of support and resistance in the market. It's based on the Fibonacci sequence, a series of numbers where each number is the sum of the two preceding ones, 0, 1, 1, 2, 3, 5, 8, 13, etc. Here's a step-by-step explanation of how to use the Fibonacci retracement tool. Identify the trend. Determine whether the market is in an uptrend or downtrend. Select key points. Choose two significant points on the chart, usually a high and a low. For an uptrend, you'd select the low point and the high point. For a downtrend, you'd select the high point and the low point. Draw the tool. Use your charting software to draw the Fibonacci retracement tool between these 2 points. The software will automatically calculate the retracement levels. Analyze the levels. The tool will create horizontal lines at key Fibonacci levels, 23.6%, 38.2%, 50%, 61.8%, and 100%. These levels are considered potential support or resistance areas where the price might reverse direction. Enter trades. Traders often look for price action signals, like candlestick patterns or moving averages, at these levels to enter or exit trades. For example, in an uptrend, if the price retraces to the 61.8% level and shows signs of reversing, it might be a good time to buy. Conversely, in a downtrend, if the price retraces to the 61.8% level and shows signs of reversing, it might be a good time to sell.